Welcome to GatePass Market Pulse Series. Today is July 20th. We sit down to discuss what investors should be thinking about as we head into the second half of the year. The first 6 months brought strong equity returns, shifts in interest rate expectations, geopolitical uncertainty, and continued enthusiasm around AI. Today, we're going to discuss what happened that brought those strong market returns, what investors should be thinking about in regards to risks, and what potential opportunities may emerge through year end. So today, I'm really delighted to have the Chief Market Strategist at First Trust, Bob Carey, join us in this discussion.
Hi, Dede. Great to be with you.
Thank you. And I'm so excited for you to be here, Bob, and I'm more excited for you to be here at this specific time, I think, in the market. There's a lot of different divergence and different moving parts. So we'll really jump right into it. And a lot of times when I have these discussions, we start with the equity side, but today I actually want to switch that up and start with fixed income, because it's a personal belief of mine that I think the fixed income market sometimes does a better job of cutting through a lot of the noise and the headline, engaging what's happening in the economy. And with that said, there's no uncertainty, right, with the fixed income market right now. And the top two uncertain, topics that come to mind are the new Fed chair, right, and Kevin Warsh, and then inflation. And even more so in the last couple of days on the inflation standpoint with the renewed, Iran conflict and higher oil prices. And when I was sitting here reflecting on, having this conversation 6 months ago, a lot of the topics seemed, similar: AI, valuations. But one of the most drastic things that I think has changed, right, in the first 6 months is Fed rate expectations. At the beginning of the year, just about everyone was anticipating 2 to 3 cuts in regards to interest rates. And now we're sitting here anticipating potentially 1 rate hike. So let's start the discussion there. What is your take on, a new Federal Reserve under, Kevin Warsh, and what is your take on where interest rates may be at the end of the year, and how could that change, right? Even the CPI number we got last week, it can change, quickly overnight. So let's start there.
That's right. I think that is maybe going to be the most important thing in the second half of the year. Of course, besides earnings, obviously, in the economy. I think, as you're so right. We came into the year thinking that we were going to get a couple rate cuts, and it made sense. We have short-term interest rates of 3.75%, so just under 4%. There were a couple of months towards the beginning of the year where inflation was below 2.5%. So you think about, we're at 3.75. We've got inflation running at 2.5. That difference to me is like a cushion, and the Fed certainly could have cut interest rates in that environment. And then all of a sudden we get involved in this geopolitical event, this war. The price of oil goes up substantially, and inflation has obviously picked up, as you mentioned. So now we've got inflation running at a hotter rate, and thank goodness the Fed didn't cut rates, because I guarantee you, if the Fed had cut rates earlier this year, and then we had these inflation numbers that we've seen here in the last several months, I have no doubt in my mind that we would see the Fed raising rates, in fact, taking those rate cuts back almost immediately. So there is a little bit of a premium, which is interesting to me, because I think back about the years where Alan Greenspan ran the Fed, and that generally was what he did during his tenure at the Fed, is he held short-term interest rates above the inflation rate. And then in the event that something bad happened, he could always cut interest rates. We used to call that the Greenspan put. You may remember that. So he holds this put option that basically, hey, if something happens, I can always cut interest rates and help alleviate whatever financial conditions that we might find ourselves in. And that's, that goes back to 1987. He was fairly new on the job when he became the Fed chair in 1987. All of a sudden, the stock market went down by a third in very, very short order in October of 1987. And so I think that's kind of where he ran policy. And I think Kevin Warsh is probably more, I think going forward, I think he's going to be more like Greenspan. I think he's going to keep rates higher for longer. And as you said, maybe even raise interest rates a little bit because of the inflation that we have. I do hope that, and I do think the Fed is probably looking past this war and the associated increase in the price of oil. And on the other side of this, I would have to think that we would see inflation come down. So the Fed might exercise some patience, but at some point, if this becomes a protracted situation, the price of oil stays relatively high, it's possible that the Fed could raise interest rates, and that I think there's no doubt that would affect fixed income in a major way.
Yeah, and I think that's a good point on, Warsh's stance, and we're still getting to know him, right? And what his policy is going to be. And I think last week was interesting with his, testimony as well as, we talk about cutting interest rates all of the time, but the Fed also has other toolboxes that they can open up and utilize. And quantitative, tightening is also something, that could come into play. Is that something you guys are thinking about or
For
talking
sure.
about?
Oh yeah, the Fed's balance sheet is very, very large relative to history. It's not quite as big as it was in comparison to the size of the financial system during COVID. Thankfully, there has been a little bit of a little bit of shrinking of the balance sheet in a real sense. But there's no question the Fed operates differently than it did before the financial crisis in 2008. The Fed actually dictates more or less short-term interest rates. And in the past, short-term interest rates were a byproduct of basically the money supply and monetary policy. So the Fed is um, operating differently compared to history. And I think one of the reasons that we have not really had a recession since 2008, we had a little bit of recession during COVID, but the fact is the Fed has, I think, for the most part, kept interest rates low enough that we've never really had high enough rates to cause a recession over this time. And at the same time, we really didn't have to worry about inflation. But then, of course, during COVID, the money supply went up substantially, and we continue to have very, very large fiscal imbalances, which leads to the money supply being created to some extent. And that kind of that printing of money, as we call it, is not something that's going away. And I think that's going to be Warsh's biggest challenge. Is we've got tens of millions of baby boomers retiring over the next 5, 10, 15 years, and that's going to put a certain amount of pressure on the budget, and it's going to be very, very hard to cut spending. So I think investors ultimately, from a fixed income perspective, probably from an equity perspective, and then from a financial planning perspective, I think we probably should have a little bit higher inflation number baked into all of our models here going forward. I've seen some of these off-the-shelf models for financial planning. Maybe you use them, and I think the default number that you do see is quite often 2.5% for long-term inflation. And I think it's probably not a bad idea to put in, kind of shock test it a little bit and put in 3%, maybe 3.5%, and see how that affects financial planning goals.
Yeah, and I think that's so true, Bob. And something we often do with clients is stress test it across different expenses as well. We know the expenses don't move in tandem as well, and healthcare expenses are going to increase at a different premium than maybe some others. And there's a point that you made in that I think is really important, and it goes back to the Federal Reserve controlling the short end of the curve. And when we look at how the yield curve has shifted at the first 6 months, almost 7 months now of the year, we saw some substantial movement at the short end, right? But it wasn't necessarily a parallel shift as we moved further out into the curve, right? So we had this flattening of the yield curve. And when we look at the 10-year Treasury, where it was sitting today, call it 4.5, 4.6% give you. When we look at that 10-year Treasury as compared to the nominal GDP, right? Is there movement that would suggest we could see an upward movement on the longer end of the curve, which we know is not controlled by the Fed, but more growth and inflation and things like that? What's your stance on if you were to look at, historically speaking, the 10-year Treasury and GDP tending to be a little commensurate in regards to their growth and where the 10-year Treasury stands.
Yeah, you mentioned nominal GDP, and that's a little bit technical, I think, but it's important to get your arms around that because it really, we always talk about inflation, we always talk about GDP numbers, but we live in a nominal world that is, it's nominal currency, nominal GDP, and nominal GDP has been about 5% over the last couple of quarters, and I think that number is expected to stay at about that same pace. And there is a tendency for the 10-year Treasury to kind of hover around that level. Now, that certainly was not the case in the post-financial crisis years, obviously. When we had short-term interest rates at zero for many, many years, you could tell that investors were not going to go back to nominal GDP as a way to price the 10-year. We just didn't have enough inflation for that to happen. But I think now that we've gone through a couple rounds of inflation, be it from COVID, the war in Ukraine, and now the war in Iran, and we've seen the price of oil go up the last couple of times when we've gotten into these geopolitical situations. I think investors are pricing the 10-year Treasury more in line with the way they used to before the financial crisis. So you mentioned 4.5%. I think that's about fair value for the 10-year Treasury. I'm glad that yield is at 4.5%. Do I wish it was 3% maybe, and we had lower inflation? Certainly. But I think for investors, I think the important thing is at least now you're getting compensated for inflation. And I think that's one of the most important things that we all need to think about is, are we, there's obviously risk in everything, whether it's fixed income or equity or crypto or real estate, everything has risk. And certainly inflation risk is something that we need to think about. And I want to be paid. If I'm going to lend money to anybody for the next 10 years, I want to get a little bit of a premium over where inflation has been recently, just to give myself a cushion. And that cushion is definitely there now.
And I think that's a perfect segue in talking about purchasing power and taking on risk as we turn to the other side of the balance sheet and look about equities, right? Because oftentimes when we're having discussions with clients, right, where can we deploy capital to make sure that we're maintaining purchasing power to and through retirement? And it's been difficult until more recently to do that in fixed income. And when we turn the page to look at the equity side of the balance sheet, wow, right? What a fantastic, past, 3 years that we've had. If you're looking at the S&P, 500, continuing, to have all-time record highs, really strong corporate earnings. And I want to start more talking qualitatively, and then we'll get into some of the quantitative, but when I think about a lot of the questions and the conversations I'm having with clients, it's almost as though people are waiting for that other shoe to drop. Not that they're wishing that a recession is happening, but it's almost like, come on, Dede, this is too good to be true. When are we going to have this recession, and almost rooting for it? How are you guys thinking about managing client expectations when you look at kind of that FOMO, right? The fear of missing out. There's nothing saying that this can't continue on the trend and continue to see these strong equity returns, but also pairing that with the inherent fear that a lot of these clients have, particularly baby boomers that are retiring that have lived through the dot-com, the 2008. And to your point, we've had some small pullbacks, but it's been a V-shaped recovery for the most part coming out of, COVID, 2022. How are you managing, client expectations in regards to that, fear of missing out versus the inherent fear that they're feeling?
Yeah, it seems like we always have that fear of missing out. That seems to just never go away. Every cycle has its own unique things that investors are basically enthusiastic about. I've seen a lot of those cycles. I am a late baby boomer. I was born in '63, so I'm looking at things differently now than I did maybe 5 or 10 years ago. And I know there's a lot of us in that kind of mid 60s age bracket that some of us are still working, some of us are not, but you start thinking about these things. And I obviously we've had as you mentioned, we've had a great market on the equity side here over the last several years. And going back, you mentioned 2022, that was the expectation was, the Fed had raised rates to 5.5%. The last time they raised rates to 5.5% was back in 2007. Look out, here comes the recession. And of course, the economy did not go into recession, and the market certainly was under pressure at that point, but it never tipped into a bear market because we never had that drop off in the economy, and we never had a drop off in earnings. I think the simple explanation, I think the simplest explanation that I can come up with is the fact that the companies that make up the market today are different than they were 5 years ago, 10 years ago, 20 years ago, certainly 30 years ago. Every time we have gone through different market cycles since the advent of the internet, and you go back 30 years ago, the internet becomes part of our lives. It becomes part of the way companies do business. It's a different world. And what I've noticed over the years, when I look at financial performance, you mentioned earnings. Earnings are just simply better than they were. Companies are better at making investments and getting returns on those investments. We think of ourselves as investors, and people like to see the stock market, and they sometimes have this perception that the stock market is a casino, when in fact it's, there's a lot of things that can drive returns short term, but ultimately it is about returns on capital. Companies make investments. We're right at the cusp of earnings reporting season. You're going to see a lot of headlines. You're going to see XYZ company reporting, X amount of earnings per share, and we might get a hint about where revenues were. Maybe the company had revenues that were better or worse than expected, but none of that happens without a balance sheet. Every company has to make investments in their business in order to conduct business, and ultimately it's that relationship between all the money that you put into the business and all the money that hopefully that business generates. Just like a bond, you buy a bond, there's a par value, maybe a market value. You earn a coupon, and you hope that coupon is enough to satisfy your requirements. And the same thing happens on the equity side. So we call them stocks, we call them equities, but really what they are is they're really variable income securities. That's probably what we should call stocks.
Mhm.
Variable but generally rising income securities. And right now returns on balance sheets are significantly higher than anything we've ever seen in the past. There was a book written back in the early part of the century. Gentlemen looked at corporate returns, looked at companies, analyzed balance sheets, looked at returns, and the average company up until the year 2000 generated about a 6% rate of return on its balance sheet. Using that same methodology, the same mathematics, if you will, we crunched the numbers, and right now those returns are north of 10%. And what that means is when the Fed raised interest rates to 5.5% back in 2022, all those companies that were generating 8, 9, 10, 12, 15% returns, they didn't care. It didn't slow them down. We never got to a point where the cost of capital was equal to or maybe in excess of what returns on capital were at the time. And returns actually have only gone up since 2022. So it's really an interesting thing for the Fed. I'm sure the Fed thought here we go. We're actually going to engineer a slowdown in the economy. It's going to bring inflation down, and we're going to have a recession. And the fact is that companies are just simply better at what they do. Maybe the best example that I can give you is in retailing. Retailing has been around forever. It's certainly one of the oldest industries, if you will. And retailing's been around a long time. But you go back 30, 40, 50 years ago, the average retailer, I think back to, I analyzed Kmart, for example, back in 1986, early in my career. And we did the math. Kmart, may they rest in peace, was a 5% return business, 5%, the biggest discount retailer in the country. It took them 6 months to sell everything in their stores and restock. So essentially twice a year, the inventory turned over. Along comes Walmart. in the 70s and 80s, and by the mid 80s, pretty much where if you saw a Kmart anywhere, especially here in the middle part of the country, there was a Walmart down the street or across the street. They turned over the inventory in their stores, selling pretty much the same merchandise every 2 months. And they did it with about the same net profit margin. So basically, through the use of logistics and technology, as you know, which is very, very primitive technology compared to what we have today, they basically tripled the returns on their business, and that's why Walmart is still around today. So it's, you think back, over the last 30, 40 years or so, now we've got Costco, and now we've got Amazon, we've got all these companies, and when we look at their businesses, we can see, for example, at a Costco, that they turn over the inventory in their stores in less than a month. Now they do sell a lot of groceries, so that affects things a little bit. But the fact is, without technology, without logistics, and the kind of improvements that they've made on figuring out what's working, what's not working, they have a much better handle on what's what's in the stores, what's in the warehouse, what's selling. You think about a Costco, you have to have a card to get in there, a membership card. You can't just walk out of there. So we don't have anywhere near the amount of theft that we used to see in retail 30, 40 years ago. I worked at a grocery store in the late 1970s, and it was just astonishing to me how much stuff just, it just was stolen. I mean, it's just incredible. I think we have a much better handle if you're running a successful company in retailing today. And the end result is that even a business that's been around forever, now these are higher return businesses that just, they don't really care whether the Fed is holding rates at 0, whether rates for 5. Now rates get to 7, 8, 9% potentially down the road. That's a different story. But I think we just never got to the point where we had a monetary policy that was too tight, and that's why we just haven't had a recession.
No, I think that is spot on in regards to some of the conversations that we're having with clients that are concerned about how long can this continue to run, and they understand the math when you break it down to them and say, okay, year to date we've had earnings growth in the S&P 500 in the mid 20s, and we've had price returns just under 10%. So we've actually seen a contraction in that valuation of price to earnings. I mean, you tell people the price to earnings have actually come down, right? This is sustainable. We can sustain at this. And then it moves on to the next question that we beg to, try and answer is this earnings growth sustainable? Is it durable? And what would potentially impede this growth from continuing? And I'm interested on your take on that, Bob, because I think you make a great point, right? In 2022, when we saw, interest rates and the cost of borrowing get higher, it didn't stop them. So what is it external factors? Is it some of this cheap debt maybe that they issued earlier on that gets rolled off and now we're entering a higher interest rate environment? Maybe that was, after 2008 and things like that, or what could we potentially see that would slow down this incredible earnings season that we've seen this year and in the prior year?
Yeah, I do think the economy itself. I mean, if like you say, so far we've been able to withstand being at war. I mean, which is pretty incredible. I mean, if you would have told me at the beginning of the year that we'd be looking at potentially higher interest rates and tightening, coupled with the price of oil surging as much as it has, and being at war, I mean, those are all things that normally would send the economy downward, but it hasn't done so yet. And I think that ultimately what the market is looking at is earnings, and that really gets back to your question: are these earnings sustainable? And I think as long as companies continue to get a return on their investments, and when we take a look at the companies that are adding to their balance sheets, it is mostly companies in the industrial space and technology, kind of AI related areas of the economy. That's where most of the capital spending is. So the balance sheet expansion that has been driving earnings and is expected to continue to drive earnings really does get back to the AI trade, data centers, all of those things. Maybe now that the price of oil has gone up, maybe we see some more capital spending from energy companies, but I don't think it's going to be enough to make a difference in the economy. I think ultimately it's going to get back to all the spending on technology. And one of the things that I do worry about is policy from a governmental perspective. There's no doubt that government policy in the late 90s, back in 99, 2000, one of the reasons the dot-com boom turned into the dot-com bust is it took quite a bit longer for broadband internet technology to get rolled out starting in the year 2000. I remember my street here in the Chicago suburbs, they dug up my street in 1999, 2000, and we were all excited because that meant that we were going to get broadband high-speed internet. We were still using dial-up. I mean, it was just, I mean, I've got that little sound in my head of the dial-up modem back then. I mean, it seems like ancient history at this point. But the fact is that it took about 3, maybe almost 4 years longer for broadband to truly get rolled out. And a lot of it was because of lawsuits and policies and all kinds of, basically political considerations that slowed this down. And now I hear that the state of New York, for example, is putting a moratorium on data centers getting built and so forth. And I start hearing that kind of stuff, and so I would say that's another risk factor that we need to think about. So I think it really gets back to whether or not all this investment in technology, IT, we've got all these different models that are coming to the marketplace and being developed. Are there going to be returns to be found on those investments? And that's really the big question. And I would kind of throw that policy uncertainty into the mix in terms of something that could upset the market.
Yeah, I think those are all great points, and to bring it all together, and I think it could be fair to say that the CapEx spending that we've seen in AI and everything has almost saved the market through a lot of this
No
uncertainty
question.
and upheld it, right? So we've seen it kind of save the day over the past 3 years, and now I think we turn the table and we say, how patient is the market going to be to get that return on capital? And when are we going to start seeing that be generated and continue to be generated through earnings? Because at a certain point, it begs the question is, how sustainable is this CapEx spending as well? And at a certain point, it has to feed through to revenue for these companies.
Yeah, I think you're right about whether or not, I mean, you think about capital spending for the most part is business to business. It's businesses spending money, helping other businesses out. We need the kind of the end user, which is us, largely the consumer, needs to be a huge player in the end. And whether it's through things that we purchase or whether it's services that we utilize, it's a fascinating thing to think about. The economy continues to come up with new products, new services like we've never seen before. I mean, the increase in the supply of different things that we can purchase as consumers it's just mind blowing. I went to the grocery store yesterday to buy crackers, and you look at just good old Ritz crackers have been around forever, and I think I counted like 19 different boxes that said Ritz on it that have all these different variations. I mean, there's just one example of all these different things. But you think about what's in your home, what's in your car, what's in your office, what you hold in your hand, your smartphones. I mean, it's incredible what you're able to do with information largely, and that's exciting. But at the same time, I think we've always seen high return businesses eventually fade and kind of revert to the mean. And every model that I use and every model that I've studied when it comes to equities always takes that into consideration. So we've got literally decades of history. And one of the things that we like to do is we'll take a successful company and we will map out all kinds of future scenarios. And this gets back to your CFA studies, right? It's multi-stage, discount modeling and all that stuff. But we're always doing it. I mean, there's a reason we learn this stuff, because we're aware that history says that things don't go on forever. We need to be sensitive to things changing. And so for every scenario into the future, we'll come up with a valuation for a sector or for a stock. And I do see a pretty hefty fade baked into the share prices of most of the large cap tech names. So these companies have got incredible businesses, very, very high return, historic returns. Some of these
Sure.
companies are doing things we've never seen before. But we can't assume that these companies are going to stay at these levels of return forever. There's got to be a fade. And for some of these companies, you've got 60, 70% rates of return. And when we look at the share prices right now, they're implying that returns will be closer to 20% in 5 years. So there is a fade baked into most companies. Now, some of these newer companies that are coming online that are more kind of pure plays on AI and the tokens and things like that. All these things, a lot of these companies are kind of laying in the weeds, spending a lot of money, not really earning their cost of capital yet. So they're like in the opposite situation where
Sure.
investors are paying up for future returns that might not be there. So that's another thing that I think is affecting the market, because I think one reason that valuations have kind of stalled out is I do think we're going to get a pretty hefty supply of companies coming to market here over the next 6, 12, maybe 18 months.
Few things there. The first I want to touch on and reversion to the mean, right? And I think one of the things that I've been quite honestly happy to see as we are trading in the first 7 months of this year is the broadening out that we've seen in the marketplace. And when we mean broadening out, right, the top, your Mag 7s of the world, there's starting to be dispersion amongst how they trade amongst each other. So people are actually looking at the companies individually as compared to, if you're looking at 23, 24, 25, they tended to trade all in the same direction. And it was almost a trade together, where now I think individuals are looking at them as separate companies. And then secondly, if you look at, the remaining 493 in the S&P 500, you start to see those players come back into play. And I think that's a really healthy sign for the market. I would be more uncomfortable if we saw, 90% of the S&P returns still coming from the Mag 7. Is this a trend that you think we're going to continue to see, or where do you see the opportunities, whether it be domestically here in the U.S. soil or overseas?
Yeah, the broadening trade. This really has been the year of the market beginning to finally broaden out beyond the Mag 7, as you mentioned, Dede. I mean, year to date, the equal weight S&P is up 12.4% as of right now, and that's almost 3 percentage points better than the market cap weighted S&P 500. This is the biggest outperformance among the 493, as you call them. I think that's a good description. We haven't seen this for several years. It's been a long, long time since we've seen the market this broad, but mid caps are up 15, small caps are up 22. I think this is a little bit of a continuation of a broadening that started last year internationally. Last year in 2025 was the first year that international did as well, and in some cases better than the S&P. We had a good year in the S&P, but you actually did better internationally. Most of that was, I would argue, is currency related. But I think that the differences in valuations between the S&P 500, the Mag 7, these stocks are very, very expensive relative to the rest of the marketplace. The equal weight S&P right now is 17 times earnings. The S&P is closer to 21, almost 22 times earnings when we look at earnings estimates this year. Earnings growth is going to be pretty much in line between the 493, mid and large. And I think investors are beginning to recognize and kind of price in the fact that it's not just those companies that are at the top of the market that are good companies that are doing well. I think one thing that's helping too, I keep track of earnings estimates like a hawk. For the most part, in the last 2 or 3 years, we get to this part of the year and we look at earnings estimates for like a mid-cap segment of the marketplace, or maybe an equal weight S&P or small caps, and it's been a disappointment. Pretty much every year in recent history, we've seen earnings expectations taper off fairly significantly, especially in the second quarter of the year. This year, that hasn't happened. In fact, earnings estimates for small, mid, the 493, the equal weight, are actually higher now than they were at the beginning of the year. Whereas over the last couple of years, the action from an earnings estimate revision perspective has been largely, almost entirely, really those Mag 7 companies in the market cap weighted segment of the market. So I'm in the camp that if I can pay 17, 18 times earnings and get nearly as much earnings growth, or maybe some cases better earnings growth in the Mag 7, I think the market will continue to reward investors that have diversified. We have a portfolio analytics team at First Trust that analyzes portfolios all day long. So financial advisors from all over will send in portfolios it could be a client portfolio, it could be a model portfolio, and they see a lot of portfolios. And one of the things that they've said to me repeatedly the last couple of years, they see a lot of portfolios that have a lot of S&P 500 market cap weighted exposure, a lot of outright exposure to the Mag 7 companies. These companies have become incredibly valuable. I mean, when you have a company worth 2, 3, 4, 5, almost $5 trillion, it's going to skew a lot of portfolios, and they're not going to be necessarily diversified anymore the way they should be. And it's been a challenge convincing people that they should have some small cap and mid cap in their portfolio. Weightings coming into the year got to the lowest levels that we had seen in modern history, and all of a sudden here we are. We've got decent returns, and I don't think this is a 6-7 month thing and then we're done. I think this is going to go on for quite a while.
Yeah, and that's we see a lot of similar, and manage a lot of similar client conversations, and it's not an intentional, I would say a lot of it's an unintentional overweight, and a lot of times you don't even realize that the top 10 companies in the S&P 500 make up 40% of the index, and then they may own some of it outright as well, and quickly you're realizing one name comprises 7 to 10% of your portfolio when you think that you've been diversified. And then it begs the question of in a taxable account, how do we do this in a tax efficient way, and how do we keep our one foot in the AI and the momentum trade, and then also de-risk. So a lot of similar conversations, and I think it's prudent, and something that we do with clients all the time is how do we be disciplined in rebalancing and getting back to the goals and objectives of each specific client. But
good old-fashioned asset allocation and rebalancing.
Yeah.
There's really no, to me, and this goes back to your question earlier about investors having that fear of missing out moment. That, to me, that's really your job, is to make sure that they don't let those feelings get in the way of doing the right thing from a longer term perspective. And I remember these conversations a couple of years ago where everybody, crypto was the big thing. Everybody wanted to own crypto, and then it seemed like gold for a time here early this year. It's like everybody's like, oh, I own a lot of gold and whatnot, and I'm like, it's like, well, and you start having questions about, well, how much do you have in gold relative to other things? And it's almost like, well, why does that matter? And it's like, well, that's what matters maybe more than anything, is how much exposure do you really have? And I think ultimately, it seems like a lot of investors gave up on international maybe 2 or 3 years ago. They gave up on small cap and mid cap. They were fixated on a lot of things, and I think this year has just been a reminder that being diversified, it just works, and it's not always pretty, and it means that you're going to have things lagging from time to time. But you just the risk. Nobody wants to take risk off when the markets are doing well, right? I mean that's always the challenge. Is I remember early in my career, I started in 1986, and I watched the market went up 50% in the first 12 months of my career, and the phone is literally ringing off the hook in the late summer of 1987, and I'm like, it was early in my career, and I'm like, wow, this is great. All these people are calling, and the guy I was working for had been in the industry since the 50s, and he's like, it's not good when they're calling in like this, wanting to throw money at us. We need to be careful about that. And then of course the market crashes in 87. And unfortunately, a lot of folks, a lot of the same people that were throwing money at the market back then, they unfortunately got out at the wrong time. And boy, that just, the market is, it's like the rodeo. It's just, the key is just staying on the animal for as long as you can. It is going to try to throw you off.
Yep, I think like with anything in life, right? It's setting the right expectations and being on your own course and not, comparing it to what your neighbor has or anything like that. So,
Exactly.
um, one other comment that you made on the previous discussion, and it would behoove us, and we're going to wrap this up here shortly, is we can't finish this conversation on the first 6 months without talking about the biggest IPO in history and SpaceX coming to light. And I think you had mentioned, some of these other companies that, may lead to further IPOs and coming to the market. What what's your takeaway from the SpaceX IPO and how do you think that affects future IPOs as we're starting to see more companies come to the public markets?
Yeah, it's a natural progression. I think that companies would eventually want to go public, especially when we've had the kind of returns that we've had the last several years. It tells you that there are enough investors with enough appetite to start putting money to work. The one thing that we need for IPOs to work is we do need enough uh, people managing money from a discretionary perspective that can make those allocations, or we need indexes to include these stocks relatively quickly. And that I think really helped in the case of the SpaceX IPO, is that there was really no delay in adding that stock to some of the bigger indexes that track that type of company in that particular sector. I think I think at the end of this cycle, whenever it may be, I do think that we will have companies coming public that are lower quality, companies that maybe have more debt, maybe have more competition, companies that are really not going to use the capital that they raise to necessarily invest in their business, but maybe more just to simply pay investors off who got in
Yeah.
before. I didn't really see that necessarily with the SpaceX IPO. It looked like, for the most part, the company was going public to raise capital, and they're going to be spending an awful lot of money, have spent a lot of money, and the company is going to continue to invest in a major way. And I think that's pretty much what we're going to see for the time being. But I think the quality of these IPOs is going to be really, really very telling about where we're at in the cycle going forward.
Yeah. And last question for you, Bob, is as we look in, the next 6 months and getting to December, there's going to be a lot of headlines, a lot of noise, right? We're in a midterm year. We have a new Fed chair, earnings season. A lot of times it's best for clients and investors to tune out that noise. But if there was one headline or one topic that you would say, okay, that's something I want to pay attention to, what would you say that would be between now and December?
Yeah, I think one of the things that I always say is don't let your politics get in the way of your investing. I mean, it is a midterm, and we do tend to have volatility, especially before a midterm cycle. The one thing that I would remind people is that the stock market actually likes gridlock. It likes it when both parties are in power. I know a lot of Republican friends of mine are like, we cannot let them take over the House, the Democrats. And I'm like, yeah, that it could happen. In fact, our economics team thinks that the Democrats will gain control of the House. They probably won't gain control of the Senate, which means that for the next 2 years, policies probably won't change. We will have gridlock, and the stock market actually likes gridlock. It means that you don't have to worry about policies changing all that much, but it does set up the stakes for 2028 become even higher at that point. And then, of course, we have a census in 2030 that is going to determine congressional districts and so forth. So, a lot of policy related political discussions, political considerations are going to be facing us not just in the next 6 months, but I think over the next 4, 5, or 6 years from a longer term perspective. So I'm watching for, where do policies go? And this data center issue is a hot topic. I know some people are wound up about this, both on both sides of the aisle and whatnot. And it's going to be a really interesting thing to see where this goes ultimately. We need more data centers. The amount of data that we are uh, producing is going up exponentially. I mean, it's unbelievable how much more data we have today versus even 5 years ago. We've got to save it. We got to store it. We've got to, these things don't build themselves. It's going to take a lot of energy. It's going to take a lot of infrastructure. And when I start seeing major states, putting a moratorium on these things, that's the market. That's not something I don't think the market is going to be necessarily happy with. The market, I think, would prefer that the private sector figure this out without a lot of government involvement. So I think that's what I'm probably going to watch, not just for the next 6 months, but I suspect probably for the next several years, and maybe even over the next couple of decades. This is going to be a very, very big political issue, I think.
Yeah, that's time will tell. So we'll see. And there's a lot of different moving parts. And I think if we were to bring everything together, right, it's staying disciplined, staying diversified, and going off, clients' goals and objectives. And we'll see. We've had a strong start to the year, and hopefully that momentum carries through. And we really appreciate you taking the time, Bob, and joining us. This was a great conversation, and we look forward to seeing how the rest of the year plays out.
Thank you, Dede. We'll be watching earnings the next couple of weeks, and hopefully we can revisit later in the year.
Yeah. Thanks again.
You take care.